Welcome, welcome to this week's edition of Reverse Mortgage Weekly, where we talk about the reverse mortgage program and try to break it down into simple explanations that's easy to understand so that more people can find out more about this wonderful program that's really changing people's lives on a daily basis. I'm your host. My name is Zach Smith. I own Chariot Financial. You can reach out to me at chariotreverse.com. That's chariotreverse.com, chariotreverse.com. They say you're supposed to say things 3 times so people will be able to, it'll really sink in. So, well, once again, my name is Zach Smith. I've owned Chariot Financial since its inception in 2019. I'm a licensed mortgage broker here in Colorado, Texas, and soon to be Oklahoma. So feel free to reach out to me if you have questions after seeing this information. So this is a little bit about me. I've been in the industry since 2003. I've been voted 5-star mortgage professional since 2017, actually. I know it says 2018, but just to put that in context, about 4,000 people are nominated each year for that award, but only 17 of us have won it 7 or more years in a row. So I'm in a good group, good company with that award. I'm also a certified senior advisor. So if you're aware of that group, you understand that that is a group that is dedicated to helping the lives of older adults on a daily basis. I'm also a mortgage broker, which most people are who do reverse mortgages. So who qualifies for a reverse mortgage? Well, a borrower for the FHA programs need to be 62 or better. 55 in some cases. There are some proprietary products out there that will allow folks to be 55 to qualify for some of these programs. So also FHA and conventional programs, it would have to be someone's primary residence. They do need equity to do these programs. That is one of the prerequisites, is that you do have to have a good amount of equity. And there are minimal income qualifications for the loan. It's not the same risk assessment as you would see on like a 30-year fixed. When you walk into the bank, one of the first questions, if you're looking for a mortgage, they'll, oh yeah, we're happy to lend you the money. But one of the first questions they ask is, well, how are you going to pay us back? So the risk assessment is, they want to determine what kind of a borrower you are. So they're going to ask about your income, your assets, and your credit to determine, put all those pieces together and say, okay, if we lend this person this amount of money, the chances of us getting paid back are going to be better. So they'll approve you for the loan and move forward that way. Well, with the reverse mortgage, the monthly payment, it's there, but it's optional. So if you have an optional monthly payment and you're not really required to make an out-of-pocket payment, well, how do they determine the risk at that point? Well, it's determined based on age and also on the amount of equity that they have, on the equity that the borrower has. And based on the age, it's like an actuary table, kind of like life insurance. So a person who is 62 can borrow less than someone who is 82, because they're banking on the person who's 82 being in the property a little less time. So they offer more access to equity. So reverse mortgage information, FHA administers the home equity conversion mortgage. That's a HECM program. Again, that's not all the programs that are available, but that's the most common programs. There's several millions of people have this program currently. And again, the amount available for a reverse mortgage is determined by the age of the youngest homeowner. So if you have a husband and wife, let's say you have someone, a husband 62 and a wife who's 58, well, they would be using 58 to determine the amount. So it's the age of the youngest homeowner. Also, current interest rates do impact the amount that they will lend on a reverse mortgage, and also the value of the home, depending on what that is coming in at. So what are the benefits of a reverse mortgage? Why are so many people choosing this option? Well, you get to keep title to your home, despite what you hear out there. Yeah, it's not a way to take your home. The bank doesn't have title to the home. You still own your home. You still have title to your home. Do you have a lien against the property? Yes. But in every mortgage situation, you'd have a lien or a deed of trust attached to your title to your property. So it's just like any other loan. Basic credit and income qualifications. Again, it's a lot easier to qualify for these if you have the equity than it would be a normal mortgage. Also, tax-free cash from equity, 30 to 74%. And again, that's going to be determined by your age. Monthly payments are optional. Use the folks, if you get a reverse mortgage, you're still going to be responsible for taxes, insurance, HOA, maintenance, those type of things. But the monthly payments are not going to be required to be made each month. You can let those go on top of the balance each month if you'd like. So, typical situations that we'll see are, number one, someone who is just getting crushed by their mortgage payment. Maybe they, like many Americans, have taken advantage of some of the equity that they've had in their home and they cashed out early. So they have a big mortgage payment. Say you have a $2,000 principal and interest mortgage payment and your Social Security is only $3,400. Well, then, you don't have a whole lot of funds to live off of and live a really quality retirement if you're having to make that $2,000 mortgage payment each month. Well, those folks, what they'll do is they'll take that and they'll convert it into a reverse mortgage to make that payment optional. So now instead of having to crack that nut every single month to make that monthly mortgage payment, they will basically be able to put that on top of the balance and let the home pay for that. So they're giving up their equity now so that they can enjoy a better quality of life. So that $2,000 mortgage payment, basically they convert into an optional payment. Well, overnight, they have an extra $2,000 in the bank account every single month. Now, is their loan balance going up? Yes, it is. And, I found that the best way to explain this program to folks is to really talk about stories. And I'm out in my business. You have to go out, you got to kiss a lot of babies and shake a lot of hands, just like a politician. You got to get out there and meet the people, especially when you're a small boutique mortgage shop like myself. My business is 100% referral. I don't have our buddy Tom Selleck out there convincing people to give me a call. No, it's just me. I'm out there meeting people every day, and that's how I prefer to do business. I'm a small boutique shop, and if I ever get too busy where I don't know the names of my clients and I don't know things about my clients, I don't know that I'm going to be interested in being in that kind of line of work. I like to be able to reach people, to know people, and to get to know my clients. So what that means is I got to go out and I got to meet a lot of people to promote my business. So I met somebody the other day. She says, I let her know, oh, I'm a reverse mortgage planner. And, so, oh, I hate those reverse mortgages. I don't like those at all. My friend had one of those and her parents had recently passed away. And they sold the property. She said, she only got $7,000 because the loan balance had grown over time. So when she sold that residence, she only got $7,000 at closing. So the first question I asked was, and just from the outside in, you look, oh, they had a lot of equity in their house, and then 20 years later, the reverse mortgage had grown to a point where she didn't have as much equity as she thought she was going to have, and she only got $7,000 at closing. Well, from the outside, that seems like a pretty raw deal. Doesn't sound like it's a good idea. Well, the first question I asked her was, well, how many payments did they skip? And there was a little bit of a silence there because not many people look at it that way. And that's one of the things that I really want to impart with how people look at this program. So when the daughter sold her parents' home, she got $7,000 and she was disappointed. But they had that reverse mortgage for 20 years on that property. And just to kind of throw it out there, the parents lived and were able to age in place that whole time. Well, if you would have had a 30-year mortgage on the property, you would have paid a good chunk of that balance down that they had left on the property. The daughter would have received much, much more at closing. But during the course of that 20 years, if they were in a 30-year mortgage, they would have paid about $280,000 over that time. And keep in mind, on a 30-year note, you're paying 50% of the interest in the first 10 years. What does that mean? That means that's a raw deal for the consumer. It's not a good deal on a 30-year fix because you're paying 50% of that interest to the bank right in the first 10 years. So even though that's the thing that everybody tells you to do, well, people tell you get a 15-year, but a lot of people, most people get a 30-year. Well, unless you're paying interest, unless you're paying principal to curtail that amortization, you're going to be paying a lot of interest over the years. So over the course of 20 years, her parents would have paid $280,000 for a mortgage. So who is going to pay for that? Especially when her parents were winding down, they were retiring. You have 3 phases in retirement. You have you first retire, and that's like the go phase. You go, you travel, you do your things, you're done working. Next phase is the slow go. You're still going, but you're just going a little bit slower. And then the last phase is the no go. You age in place and things start winding down. So during that whole time, somebody would have had to pay that $280,000. Who would it have been? Would it have been the parents? Is it a situation where she would have watched her parents pay that $280,000 over the 20 years that they were living in the home? And that's the thing that really breaks my heart, is when we see people taking their life savings to pay a mortgage. That's really not a good recipe for success. And we have some data that will show that here if we get to it in this presentation. If not, you can see some of my other presentations, or maybe we'll dive into it next week. But that's the thing, is that over that 20 years, someone would have had to pay that $280,000. If it was the parents, would they have been able to even stay in the house if they had to pay that mortgage payment over 20 years? Or like Forbes, the article they had in Forbes magazine a few years ago that talked about how our parents could be our biggest financial risk because of the rising costs of healthcare. Would the daughter have paid that $280,000? Somebody would have had to pay that $280,000 over that 20 years. It's kind of like that saying that, everybody wants to go to heaven, but nobody wants to die. So that money would have had to come from somewhere. So what they chose to do is they chose to get a reverse mortgage 20 years ago so that they could defer that $280,000 and live out the rest of their golden years in ease, in grace, and not having to worry financially about, oh gosh, I got to make this mortgage payment. How much money do we have in the nest egg? Can we move funds from here, from there, so that we can make the mortgage payment? That's the trade-off that you're making with the reverse mortgage. Yes, you do have a negatively amortized loan if you choose to structure it that way, but you're getting something out of it. Her parents were able to live the last 20 years of their life in a much better, easier, and peaceful situation than they would have if they were making that mortgage payment. So that's really the trade-off that you're getting with the reverse mortgage, is peace of mind, especially if they were taking money out of their savings to pay mostly interest on a mortgage. So that's one thing that I really want to impart with people, is that, and the other thing about that is that, this is just like any other mortgage. The reverse mortgage is just like any other mortgage. In fact, you can treat it just like any other mortgage. You could take out a $200,000 line of credit, and, on a traditional loan, you have your monthly payments, you pay it back in 30 years, you're done, or 15 years, however you want to structure it. Well, you can do the same thing with a reverse mortgage. No one is stopping you from making monthly payments on your reverse mortgage. There's a sentiment that if you take a reverse mortgage, you're automatically going to be in a negative amortized situation. No. If you go negative amortization on a reverse mortgage, it is a choice. It's not a necessity. You can make a monthly mortgage payment. You can pay off the loan. You can treat it just like any other mortgage. And that's another thing that I just don't think a lot of people focus on with this program, is that it really truly is just like any other mortgage. It's just that it's much, much more flexible, because you don't have to make that monthly mortgage payment if you don't need to. So again, that's really the philosophy of the reverse mortgage. And, it gets even more beneficial when you start looking at it from a financial planning aspect. So let's see how much of the presentation we can get through here. So the two biggest myths that I see with the reverse mortgage is, we got our fella there with the with the tinfoil hat there. One, you lose title to the house. Couldn't be further from the truth. It's a loan just like any other. You still retain title, you still retain ownership. And number two, that you're upside down on the property after you take one out. Is it possible to go upside down with a reverse mortgage? Yes. But you know who the big loser is in that situation? The bank. The bank does not want you to go upside down on your reverse mortgage. Why? Because banks have become very good at what? Making money. That's why we all sign up for the 30-year fixed and give 50% of their interest in the first 10 years, because they're very, very good at making money. And how do they not make money? By getting an asset that is worth less than the lien that's put on the property. So they are taking risk by doing a reverse mortgage, because if you go upside down, they lose. The bank loses if you go upside down. So they structure these loans so that you don't go upside down. So, but there's a sentiment out there that the bank wants your house, they own your title, and you're going to go upside down automatically. Couldn't be further from the truth. And that's really the main purpose why I do these every single week. You don't have to use us for a reverse mortgage here at Chariot Financial, chariotreverse.com. You don't have to use us. You can use whoever you want. But understand the program so that you can make an honest decision, not just for you, but for your family. And make sure your family understands as well, because, like the situation I gave previously with the daughter who was disappointed at closing, she was only able to grow $7,000 from her parents' home. Remember, somebody would have had to pay that $280,000. So know that there's a benefit there that they're getting. The other option, they could have sold the home and moved in with her. There's a lot of other options that could have taken place. But by doing the reverse mortgage, they were able to structure things the way they wanted. And that's a really important part of this, is the control piece in regards to your assets. So let's talk a little bit about retirement in America. It's hard to talk about programs that are structured towards older adults without talking about retirement. So here are three pre-retirement buckets. These are your three buckets of finance. The red bucket's your income, yellow bucket's your assets, green bucket's your home equity. Most of us are making income when we're younger and depositing it into our nest egg, our 401k, our savings. And then we're also paying off our home at the same time. The state of affairs, I'm not going to go into these details. If you want somebody to talk your ear off about this, talk to a financial planner and the state of affairs in regards to savings in America. The long and short of it is, the people that are saving, and not many of us Americans are saving, but the ones that are just not saving enough. Especially when you look at folks my age. I'm 45. I don't know if Social Security is going to be around when I'm eligible for it. I have no idea. So being able to save and to save enough is really a big issue. Again, I'm not going to go into much detail, but call up your local financial planner or whoever you use and ask them about the state of affairs of savings in America. They will talk your ear off about it. Again, we're going back to the buckets here. It's just a nice visual, and that is income, assets, and equity. Well, post-retirement, these buckets change quite a bit. As you can notice, the income shrinks. A lot of times when people go into retirement, they get into a fixed income situation. They're just not out making as much money as they did while they were working. Number two, the savings becomes very important. So it's in a throne here. And the reason it becomes so important is because we don't know how long we're going to need it. We could have, our savings. We could live till 70. We could live to 80. We could live to 90. We could live to 100. We don't know how long we're going to live. So if you have a financial planner that's planning to 70, well, what if you live to 100? That's 30 years of income and savings that you're going to have to account for. The biggest fear that a lot of my clients have is running out of money prematurely. So that's why the savings becomes vitally important in retirement. Well, the green bucket here, your home equity, is usually just sitting there. Many of my clients are equity rich and cash poor, or they are equity rich and they're looking to do financial planning with a reverse mortgage. But the vast majority of them are looking to tap into that equity. Equity is great to have, but it's a lot like having a glass coffee table full of cash right there in the middle of your living room that you can't get to. The thing about equity is it's not like we can take a picture of our house and go pay for our groceries with it. It's great to have equity, but the problem with equity is it's not liquid. And that creates a big problem for folks when they are equity rich and cash poor. So again, these buckets change quite a bit. And what the reverse mortgage does is it helps people access that equity. That glass coffee table right there in the middle of the living room, well, it basically creates little drawers so they can pull out cash when they need it. Again, home equity is quite prevalent right now, especially because home prices are still going up. I mean, we're pricing folks out in the 7s and 8s on our forward mortgages. High 6s here at Chariot usually, but we're pricing people out much higher than the 2 and 3% that we were previously. And the housing market has really stalled quite a bit, but the prices are still going up. We just got the figures out here in Colorado. We still have a 4% increase in prices for real estate, even though the market has slowed down to a much slower level than it has been in previous years. So even though it's slow, the prices are still going up, and that's because of demand. Freddie Mac, quasi-governmental agency, did a huge study in 2021, and they predict that 50 million millennials are going to be entering the housing market in the next 10 years. Why? And that's, I talk a lot about this, about what they quote unquote smart money on Wall Street. We're talking about the hedge fund folks. The folks, the BlackRocks, the Vanguards, and all those different hedge funds that are basically all about making money. These guys are stockbrokers. They're number crunchers. They eat, they sleep, and they breathe profit, profit, profit. How can we make more money? Well, where are they putting their money right now? They're putting it into real estate. They know that there's a big tsunami of people who are going to be coming of age, starting families, wanting to purchase homes, the millennials, which are now the largest population segment. The baby boomers used to dictate what the economy did. What the baby boomers did, that's where the economy was at. Well, now it's going to be the millennials. And they're getting of age where they're going to want to branch out and have a yard, maybe start a family. They're doing things later than the previous generations. But now they're coming of age and they believe that they're going to want to start doing these things. So what are the hedge fund, the quote unquote smart money doing right now on Wall Street? They're buying up real estate in suburban areas. So the point I'm trying to make is that equity is going to be something that's going to continue to grow because there is a raging demand for housing right now in the United States. So again, what is equity? It's cash that's accessible unless you sell or take a loan out and pay it back. Does it really benefit you in retirement? Not really. You can't take a picture of your house and go to the gas station and pay your gas with it. Is it better to pass on a higher net worth or more equity? That is a very good question that I think a lot of folks who are thinking about this program should ask themselves. Do I want to pass on a higher net worth, or do I want to pass on more equity to my kids? 9 times out of 10, the kids, when they get bequeathed a home, what's the first thing they do? Well, they call a real estate agent to sell it. Very rarely do people keep the homes that their parents have lived in. So what do people usually, again, what do people usually do with homeless bequeath? And does cash do better in your pocket or locking it up in the home? It's kind of like folks who are buying properties with cash. I don't, unless you're, unless you're trying to launder money or something, it's probably not a good idea, in my opinion, to buy a home with cash, because then you don't stay liquid, especially now. It's kind of like there's that saying that there's always opportunity. You just got to know where to look for it. Warren Buffett he's done pretty good over the years. His saying is, when people are greedy, be scared. And when people are scared, be greedy. Well, right now people are scared because the interest rates have gone up so high. But you can get a CD now that's actually going to pay you back something decent. So what if you were to take funds that you normally would be putting into real estate, where, there's nothing wrong with that, but you could take those funds and put it in the CD and get the money to go to work for you. So it's just a matter of how you're looking at things. Because once you put money into a real estate transaction, cash, you lose all control over it. You can't direct it anymore. You put that money in the hands of a bank, because if you want to get it back out, you got to call a bank to get it back out. Or you put it in the hands of a buyer, because if you want to get the money back out, you'd have to sell the property. In my opinion, I think it's better to leverage real estate for victory so that you can direct those funds, stay liquid, and direct those funds into higher yield and get that money to go to work for you. There's two different camps out there. Well, there's a bunch of different camps, but the two main ones that I've run into over the years is you have the Dave Ramsey camp that says, hey, debt's bad, pay everything off, don't have a mortgage, don't have a car payment, pay everything off. And I agree with that. I agree with that wholeheartedly, except when it comes to mortgage financing. Because you have the other camp, the Robert Kiyosaki camp, rich dad, poor dad. Well, if I have a mortgage on a property for $2,000 a month, yeah, I've got a mortgage, but what if I'm renting it out for $3,000 a month? Is that really bad to have that debt? No, because you're going to stay liquid. So a bunch of different ways to look at it. Again, I fall more in the Robert Kiyosaki camp, leveraging real estate for victory. Well, we try to keep these at a half hour. Looks like it's about 2:30 Colorado time. I'm very happy to be of service, even if you just want to bounce questions off me. I'm always able to help and open to receiving questions and things like that. So feel free to give me a call anytime. You can reach out to me at chariotreverse.com, chariotreverse.com, chariotreverse.com. Thank you so much. Once again, my name is Zach Smith, and I own Chariot Financial. Been very nice spending some time with you today, and I hope today brings you blessings, abundant blessings to you and your family of health, goodwill, and prosperity. Thank you so much, and you have a great rest of your day. We'll see you next time.